Welcome back to the channel. Um, this is the second video um, focusing on mindset and the psychology of trading. Once again, we're not going to get into the physical act of trading. We're going to talk about just the trading mindset and the things that you need to do to make it a lot easier, make your pathway to successful trading a lot shorter. So the reason why I started these videos with the mindset rather than just actually teaching you how to analyze the charts and how to set up a trade is because I do believe that the mindset is far more important than actual chart analysis and getting an edge. Because even if you have a perfect setup, if your mindset isn't correct, you'll still lose. You will still lose. You'll still not be profitable. You'll still do foolishness on the charts. But once you've gotten that proper setup and your mindset is right, there's very little that can stop you from being profitable. Right? So psychology is key and it's oftentimes overlooked. And so that's why I've started these videos focusing more so on the mindset because I want you to start off with a foundation, a mental foundation of what you should do and what you shouldn't do in terms of trading. And I believe once you start off knowing these things, then it will be easier for you because the charts, you can just see that as physical and easily repetitive, but the mindset is what makes it easily repetitive. All right. So it's like going to the gym and lifting weights. The charts is the actual act of lifting the weights, but to get you to the gym, your mindset has to be right. Because if you don't feel like getting up in the morning and you actually um, fall victim to that lazy feeling, you're not going to go to the gym. So if you feel like uh, just not sticking to your trading plan and you don't stick to your trading plan, you're going to lose. So your mindset is important. Even if physically you can lift the weights, physically you can analyze the chart. If your mindset isn't right, it doesn't matter. You're not going to be profitable. So let's focus on the mindset. Now, one of the videos that really helped me with my mindset is a video from the YouTube channel Hit Back. And it's a video by a former prop firm owner. And he's basically giving the details from that prop firm as to who the top performers in that prop firm were. And so I'm going to be reading off of, well, I took screenshots of it. I'm not going to enter, I'm just going to tell you the name of the actual video, but I'm not going to add it to the screen. Um, so at the end, I'm going to tell you about that. But let's just start it off. So he starts off his video by talking about the success rate of the traders in his prop firm. And he says only on average, about 22% of traders were successful. And these traders took 2 to 3 trades per day. All right? 2 to 3 trades per day. So again, you can see that the majority of traders were failure. Well, let me not use the word of failure. The majority of traders weren't profitable. Only 22% were profitable. And what he found is that of those 22% of traders, what he noticed is that they only took 2 to 3 trades per day. So the fewer trades you take, the more likely you are to be successful. Meaning that if you take a trade and you win, that's it. Step away for the rest of the day. If you take a trade and you lose, you're allowed one more trade. And if you lose that trade as well, step away, call it quits, come back another day. Because it's very easy to lose. And so if you lose and then you lose again, chances are the next trade, you're likely going to lose that trade as well. So step away, accept that you've lost, go about your business for the rest of the day. It allows you to have capital in your account to come back the following day and trade again. There's a saying that goes, he who runs away today lives for another day. Well, it's basically the same thing. Or lives to fight another day. This is the same thing with trading. So if you've lost, accept it, go away, come back the following day, you can trade again. All right. So take 2 to 3 days, 2 to 3 trades per day. The risk to reward ratio that was seen in most of the profitable traders, 1 to 2 to 2.5. Some 1 to 3. So the ideal risk reward ratio would be about 1 to 2 to 1 to 2.5. That's your risk reward ratio. I would not encourage anybody to take a risk reward ratio less than 1 to 2. It means that if you take a risk reward ratio that is less than 1 to 2, let's say you do a 1 to 1 ratio, it means that if you lose a trade, the next trade that you take, if you win that trade at that 1 to 1 ratio, all you're doing is you're recovering the money that you lost. You're not making any gains from it. Whereas if you take a 1 to 2 ratio, you take the first trade and you've lost, you take the second trade and you win that, you would have made back the money that you lost plus gained. So your account actually increased even though you lost the first trade. If you took a 1 to 3 ratio, you'd have doubled your money even if you lost the first one. I don't encourage 1 to 3 ratios, however, because from my experience, more often than not, price starts to retrace between that 1 to 2 and 1 to 3 level. So you're less likely to hit that 1 to 3 level. Of course, if you take the 1 to 2, it's less money as compared to the 1 to 3, but less money is better than no money. All right? Less money is better than no money. You come back tomorrow, you take another 1 to 2, and you're good to go. Especially if you have a large account. Remember, do not be greedy. Greed is one of the main reasons why you lose in Forex trading. So ideally, 1 to 2 ratio. Now he speaks about the average days I took to pass, but we're not doing prop forms here, so average days really doesn't matter. Now let's jump into another characteristic. Let's talk about the losing traders. What are some of the characteristics of losing traders? Well, the first things he speaks about is risk management. Now, risk management is also one of the key things in Forex trading. You have to manage your risk. The goal is to make money, yes. But more important than making money is protecting the money that you already have. And in order to protect your money, you must have a stop loss. You must have a stop loss whenever you're trading. Have a clear stop loss and have a clear take profit. Never move your stop loss. Don't adjust it. If you're holding a trade overnight, or like for me, when my broker closes for the day, what they do, the spreads get really wide. And so the only time I move my stop loss is when I see the market is about to close and I know the spreads are going to be wide. I move my stop loss further away so that spread doesn't take me out. And after that 1 hour where the market is closed, the spreads come back to normal. The spreads come back to the value it was prior to the market close. And so when it does that, I then move back my stop loss to where it was initially, therefore protecting my account. But I never look at the market and look at how the market is moving and say, you know what, let me move my stop loss. No, don't move your stop loss. There's a reason why you put your stop loss there. You analyze the market and you thought that this area was the perfect area so that it gives the trade enough room to breathe. And so I've given it enough room to breathe. And if it gets to the point where it touches my stop loss, it means that there's no choice or no chance for this market to change direction and go back into profit. So I accept that. But if you move your stop loss and you give it more, you're basically offering up more of your account to lose on an already losing trade. So set your stop loss and leave it there. Don't move it. What some persons like to do is they like to move their take profit so that they can gain more. As I discussed earlier, the 1-to-2 ratio is ideal, but you're going to have some trades that you can tell they might move so rapidly, or the momentum might be so strong that it turns into a 1-to-3 or a 1-to-4. And some persons want to take the risk because they want to make more money, but these opportunities don't happen that frequently. So whereas with the 1-to-2, you know you've made your money and you can go away knowing that you've secured this money, as opposed to taking the chance of potentially making a bigger profit. But with that chance, you know that you could also lose the profits that you already have if you had closed the trade. So be mindful of that. Yes, there are going to be situations where price is going to go way beyond your take profit in that 1-to-2 ratio. But remember, a bird in the hand is worth two in the bush. It's better to have secured a profit and be quite disappointed that you didn't get a larger profit than to go after a larger profit and lose what you have already had. All right. So the losing traders, they lack a stop loss, a clear stop loss, and they lack a clear stop take profit. And they tend to move their stop losses, causing them to lose even more money, which might lead them to blow their accounts. Scalpers. Scalpers lose quite frequently. Scalpers are the ones that they use the 1 minute, 2 minute, 5 minutes, 15 minutes chart to make their money. And they just jump in the market and they spend a couple of minutes taking advantage of the current rapid movement of the market. But because it's rapidly moving and it's on such a small time frame, it means that that movement isn't solid. At any time, that direction can change. Let me say this. The higher the movement within a high time frame, the more likely the price is going to continue moving in that direction in the long term. The lower the time frame, the less likely it is price is going to continue moving in that direction in the short term. So higher time frames predict long-term movement. And that's why I like swing trading. That's why I like swing trading, because it takes advantage of a long-term movement of price. Right? A constant lot size usage results in a higher exposure. So let's say you have a $1,000 account and you're trading a 0.5 lot size and you keep losing. And instead of adjusting your lot size to the account, you keep using that same lot size. So whereas a lot size, just hypothetical for this argument of just to make it more understandable, the example more understandable. Let's say with that 0.5 lot size, you're risking $50 on a $1,000 account and you lose that trade. Let's say you lose 2 trades in a row. So now you've lost $100. When you use that 0.5 lot size for your third trade, it's not going to account to a $50. It's going to account to, let's say, about a $70. So now in a smaller account, because you've already lost $100, you're risking a greater amount of money. The percentage that you're risking has increased. And that's why I say instead of risking a consistent amount of money, risk a consistent percentage instead. So risk 3%. So if your account goes up to $1,050, you do 3% of 1,050. If your account goes down to $950, you're risking 3% of 950. So a consistent percentage, that's how much you should risk. Persons who trade with a low risk reward. So their risk reward ratio is 0.5% or a 1-to-1. It means that you can't make back your money if you make one profitable trade. Well, you can make back your exact amount of money, but you don't increase your account. You don't make anything extra. A 1-to-2 ratio covers the amount of money that you lost in the previous trade. It gives you the opportunity to make that back, plus add to the account, so it grows your account. Over trading. So I just said earlier that profitable traders, they take 2 to 3 trades. Once you go over 2 to 3 trades, you're over trading. The more trades you take, the less likely you are to win. Forex trading is one of those things where less is more and more is less. The less time you spend in the market, less time you spend in a trade, the more money you're likely to make. The more time you spend, the more emotionally involved you get, the more money you're likely to lose. Emotions are key. So take fewer trades. Gold. Gold. A lot of persons like trading gold because they think they can make a whole lot of money from trading gold. I will tell you, gold is highly manipulated. It's highly manipulated. And because persons also think that they can make a lot of money for it, that's one of the reasons why it's so highly manipulated. But because persons think that they can make so much money from it, they tend to throw caution to the wind and they break all the rules They don't use proper risk management, they overtrade, and they end up blowing their account. So be very, very careful in terms of trading gold. I don't trade gold. I've like back, let's say 3, 4 years ago, I used to trade gold, and I realized that I would just constantly keep losing, losing, and losing. And so I stopped. I don't trade things that I don't win from. And that's where journaling comes. Journaling helps you to see what peers you're making constant wins and big wins, and what peers you're not good at trading, what are the trades or the peers that you trade that very frequently you lose or you make big losses. So be very careful with trading gold. Don't get caught up because it's shiny. It's gold. What do winning traders do? They have a stop loss, they have a take profit, they have better risk management. So, like I keep saying, 1 to 2 ratio, and they are swing traders. Swing traders. All right. Swing traders. Some scalpers and some intraday traders, but swing traders win the best and they win the most. And they take fewer trades. Well, the whole idea of swing trading is to take fewer trades. So the ideal trader, let's put it together now. The ideal trader has a stop loss, a take profit, which they don't adjust. They have a risk reward ratio of at least 1 to 2, ideally 1 to 2 to 1 to 2.5. They're swing traders. They take fewer trades, a maximum of 2 to 3 trades per day, sometimes even 2 to 3 trades per week. All right. They journal and they stay away from peers that they don't have a history of winning from. They don't have a nice history of winning from gold or whatever other currency pair, and they stay away from those peers. You want to maximize on the things that you have a good history with and minimize on the things that you have a bad history with. That's the key. Right, so I hope you guys enjoyed this video. I hope you guys learned. I hope that you were making notes, and if you didn't make notes, I encourage you to re-watch the video and make notes and try to follow those notes. Put those notes into practice. These are the things that I did that helped me to become profitable, and I encourage you to do the same. I spent many, many hours, not just learning to analyze charts properly, but looking at different videos talking about psychology and the mindset that you need to use and some of the things that you need to do in order to become profitable and consistently profitable as well. And I will tell you, I did not want to journal. I found journaling very boring and tedious until I started to realize why you journal. You journal to analyze what's working, what's not working, and not just in terms of taking the trade, but what sort of mood you were in when you took that trade. So you can work on each aspect, and the journaling is what allows you to see it. It's like keeping an inventory of your sales of your business. What items are selling the best? What time of the year do these items sell? What type of customer buys these items? That's the information that journaling gives you. All right. Hope you guys enjoyed this video, and I'll see you in the next one.